Hi, everybody. Welcome. I'm Hope Wood. I'm Andromeda's head of business development. And thank you very much for joining us for our Q1 webcast today. We have Alberto Gallo, Adi Ani, who are our co-founders, and Brendan Breen, our senior credit analyst, who are going to discuss the outlook for credit and opportunities that they're seeing in the markets. The webcast should last roughly 30 minutes, and please feel free to add questions to the chat, which we'll have time to address at the end. Alberto, I'll let you take it from here.
Okay, thank you, Hope. Thanks, everyone, for joining, and welcome to our first webcast of 2024. It's a very exciting year for credit. It's a year where the credit cycle is in a goldilocks stage. We're in late stage. Investors and economists have been looking forward to central bank cuts. Spreads are tighter, volatility is lower. But the interesting, exciting thing for Alpha is that there's more dispersion. And since the beginning of the year, there's already several capital structures that have gone into stress in the European high yield market, for example, Atos, Grifols, and today Intrum, which just started discussing a potential restructuring of its debt. So perhaps last year there was a lot of beta, there was a pivot. This year it's a lot more about alpha, and we're pretty excited to be able to capture opportunities both on the long side and the short side. So let's have a quick discussion about where we see the economy and the outlook for growth and inflation and the Goldilocks cycle in credit, what it means for defaults, where are the opportunities. And then Adi and Brendan are going to talk about more of the sectors and single names where we are active in and some of the examples of the opportunities that we're capturing. Continue to be that we're higher for longer, both in growth and inflation and in central bank rates. So in other words, we started the year with 150 bips of cuts at the Fed and the ECB. We're now at around 90, 95 bips. We think that's still too much. The Fed can cut. The Fed will cut because they can, but not because they have to. It is a very strong economy, and we actually see already the reacceleration from the loosening of financial conditions that was created by the Fed last year. What's happening in financial conditions? Spreads are close to record low, especially for investment grade. The housing market is starting to reaccelerate. We see signs of easing in lending standards in the US housing market, but also in Europe, where banks have been making really good results. And so because of all this, well, we can ask ourselves, what's going to happen to inflation? What are central banks not doing? And what central bankers are not doing is they're not moving up the long end. The increases, the higher interest rates in the front end are really only hurting the bottom 50% of the population. And that part of the population, unfortunately, is SMEs, small firms, small businesses, and households that are more levered, which are not part of the S&P and not part of the bond market. So the Fed is not really hurt anyone in financial markets by keeping the front end so high, but leaving the long end too low without quantitative tightening. Having said that, persistent high rates can still hurt the bottom end of the credit market, of the firms in the credit market. And so we've always discussed about the good, the bad, and the ugly. And the good are very tight. They're the investment grade firms where there's no opportunity. And the bad are defaulting, and the ugly are in the middle. Maybe there's opportunities right there. We'll talk about it in a few. So where are we? We're forecasting above average growth still. We're forecasting above average inflation. And we are also forecasting that spreads and rates, particularly rates, might back up a little higher later in the year, especially because we spend a lot of time on monetary policy. We never talk about fiscal policy, but the one word you have to think about, and we've talked about it in the past, is Trump. Trump and fiscal policy go hand in hand. The deficit from the Biden administration continues to be really expansionary. And in the run-up to elections, both in the US and other countries like the UK that have elections this year, we see continued spending to fight that election battle. So more tax cuts, more spending, especially when it becomes permanent handouts, like some of the other ones that we've seen being proposed in the US, that's more inflationary. And so we don't think you get paid here. We think that both treasuries and bonds need to go a little higher. And with that, we could see some more volatility in spreads next year, in the second half of the year, and as we go into next year. The other thing to keep in mind, obviously, it's the BOJ, the central bank. That's the elephant in the room, and they haven't hiked until now, but they will eventually. So we're going towards an environment where, we had essentially a deceleration in growth. We're now having a reacceleration in growth. Inflation is still stable. So it looks like a Goldilocks, but potentially later on, we could go more on the top right side of the quadrant where you have both growth and inflation accelerating. So the momentum is positive, both for growth and for inflation in our view. And we've just seen the PPI data, which was, again, stronger. We had a second print in February on stronger CPI and PPI today after the January print. So what does it mean for the credit cycle? Well, higher for longer after 15 years of low rates means higher defaults, but growth is positive. And so these defaults are not coming in a bunch of 10% in a cluster. They're coming in small clusters, in small areas that are the sectors that are weaker, the sectors that are used to fund the 2-3% that now have to go higher. And so they're more gradual. They're more gradual also because there's still a lot of capital on the sidelines in the credit market, because the long end is inverted, because only the front end funding costs has been increased, and the long end is where most investors go to fund themselves. So we have a forecast of defaults in the US and Europe, roughly doubling from current. Big distress cycle or a big COVID crisis, you're probably going to continue to be disappointed. But there is value in sectors and specific opportunities and in the volatility of the liquid market. And we do see rates continue to go higher. Now, if we think about where the opportunities are in credit, and we look at the credit market and where the yields are and where the size of the different segments of the market is and the duration, well, we basically we believe that there is a lot of overcrowding, both on the left side and the right side of this chart, where the left is safer, more senior, investment grade, the so-called high quality credit areas of the market. The average duration, the average maturity of US investment grade has gone to 13 years. The spread on the CDX-IG index, where we are at all-time longs positioning, is below 50 basis points. It's just a handful of basis points above the record tight. And so the high quality credit has been extremely popular, but essentially it's a duration trade. We don't see value there. There's also a lot of crowding on the right side of this chart, where you see private credit, 1 trillion of deployed capital. The yields are marginally higher than what you have in public markets. And you have $500 billion of undeployed capital waiting, fighting to get in. And very often what we see is companies that are in the public market that cannot fund in public markets. They go to private markets and they get better deals as 2 or 3 funds are competing. So we see a shrinking premium, a relatively tight premium between private and public markets, not worth the illiquidity and locking your capital. We see better opportunities in the middle. The sweet spot, in our view, is in the middle, in high yield, in levered loans, and in emerging markets, and in some of the niches that still investors haven't captured across these markets. And here you see the premium between private over public credit, which is around 2%, but it's been even lower. So when public credit is volatile and reprice is higher, the premium almost goes to zero. And it's much better to be in public credit, where you can capture a lot of other opportunities and don't give up the optionality of locking your money, your capital, for a number of years. What's attractive today, if you look at the credit market, I always like to show this slide, which is a snapshot of everything. I mean, the spreads today on the market are a little bit tighter than they were last year. Last year, we went from a moment of fear in March and then in October to a moment of euphoria, with the Fed pivoting and a lot of cuts being priced in. And we still are in that euphoric moment. So we're record low, close to record low in investment grade spreads, a little higher in high yield spreads. Real rates are still interesting. So the all-in yield is interesting. But at this point in the cycle, in the late stage, you really want to focus on alpha opportunities. And the only reason to not be short on the market is that fundamentals are still strong overall. So leverage has not gone up. Financial conditions have loosened. Investors have been squeezed. Valuations have changed, but fundamentals are still good. So it's not a time to position for massive shorts. And here you can see our gradual default rate forecast. So where is the value? Well, the value is not in investment grade. We talked about it. In private debt, you're giving up optionality. The sweet spot of high yield, which you see here in red and orange, is still overall above valuations, above the historical average. But within high yield, within financials, within emerging markets, there are specific opportunities that look more interesting than others. And dispersion is increasing. Dispersion is increasing, particularly in Europe, where you see that finally some of the shorts, some of the bad apples are falling from the tree, and the market is not as compressed, it's not trading as one thing as it was last year post-pivot. So if we think about what are the sectors that have generated more volatility, that have essentially decoupled from the market, there are obviously some clear cases. In Europe, it's real estate, it's some of the utilities, some of the energy names, some of the banks. And in the US, it's telecoms, media, large capital structures like Comcast or Dish, and some of the retailers, think about Macy's, for example. Brendan is going to talk about that in a second. But gradually, we see that the riskier sectors are starting to decouple, to move away from the average market. So when we look at our process, when we think about where we want to be in this part of the cycle, in one word, we want to be the second loss taker. We don't want to be in the riskiest names or in the bottom of the capital structure, because we're late in the cycle, because default rates are rising, and inflation will probably bottom at some point in Q2. So we're going to be in a world that's not the pre-COVID world. It's not back to 1% interest rates. Not all the boats are going to be refloated by liquidity. So we want good quality issuers that can go back to positive free cash flow. We want to be in the right bonds with the right subordination, but also we want to be co-investing with the right institutions. So in many cases, governments have helped European high-yield companies, and also sometimes in the US, in the strategic sectors, and in many cases you have shareholder support. In other words, what you can say today is that for the first time in 20 years, as a bondholder, you have the upper hand in terms of bargaining power. And you have seen a lot of companies like Bayer, for example, cutting dividends and increasing in order to pay interest, in order to deleverage. So today, bondholders have, for the first time, the upper hand in the cap structure compared to shareholders. So what do we like today? Very, very quickly, what we like to have in Europe are things that are anti-consensus in a way. We started the year with a lot of consensus on China growth imploding, on the auto sector being in a very tough competition, Germany going into recession, and so very high valuations here. We still like banks, we still like energy, and some of these areas which we discussed last year. On the opposite side, on the shorts, what we don't want to have or we want to short are names that only survived with low interest capital structures, names that are vulnerable, or countries that are vulnerable to high commodity prices and high inflation, and essentially SPVs. So companies like Intrum, which today announced a potential restructuring, companies which are only a box with low interest liabilities and interest-dependent assets on the asset side, which cannot survive with the repricing of interest rates. Obviously, there are other special situations. Brendan is going to talk about this in a second, that we're more involved in. And I would say at this point in the cycle, we want to be in areas where you're the second loss taker, you have shareholder support, you have good bond features, and as idiosyncratic as possible, because we are at low levels in market spreads. And, we have been up every month last year, continue to be up every month this year. We're focusing a lot more on the idiosyncratic opportunities as we go late in the cycle. I'm going to pass it to Adi now to discuss some of the names we've been active in corporates and financials, and then Brendan will talk about some of the special situations.
Thanks, Alberto. So as Alberto was saying, we still see a lot of rhetoric in the market talking about basically, hard landing and recession fears, especially in Europe. We think these concerns are overpriced in the market. And secondly, we still see a number of shorts within some of these spaces. So we still see a number of shorts in autos, in energy and travel, to sort of talk about a few. When we look at these names, there are two things which we start to look at, which is essentially, where do we get the most amount of convexity? Now, in some of the travel names, you have the optionality of looking at convertible bonds. So things like Lufthansa, 2025s, those are convertible bonds. Air France Perpetual has a convertible bond. These are essentially where we have spreads trading at about 150 to 200, but you have the convertible upside on the equity, which is actually quite a depressed level. Same story sort of on the energy side. There are a number of energy companies, especially in the US, which are trading pretty tight, under 150 spread. Having said that, there are value that we see in some of the Northern European providers like Enquest, like Ithaca, as well as to some extent even Pemex, where essentially we got Mexican elections this year, and we think that the government will continue to support the front end by providing incremental support, as well as we've seen the company pursue more aggressively an ESG strategy to try and align itself with what we're seeing in E&P companies the rest of the world. The reason this is important is because it basically allows Pemex to go back in some of the indices and go back in some of the holders who've basically been selling it. Similar story on the autos. We see a lot of sort of spread compression. For Asia trades under, near 200 basis points of spread, but there is value. So for example, we see, Tenneco, which is an auto part supplier, still trading, above 500 spread. Closer to 600. Same story with Aston Martin, which issued yesterday, closer to 600 basis point of spread. Today in the secondary, Aston Martin has strong sort of shareholder support. It's been historically a free cash flow negative company, but they're turning that around this year in the second half as we sort of have more production capacity coming on. I'll let Brendan in a second talk about the pubs, but it's a bit more of a niche sector. With a specific idiosyncratic catalyst in the UK, where we're looking at a number of asset sales, which will allow a refinancing. Similarly, when we think about the cyclicals, a sector which we've been long on is the banks, specifically the tier 2 and 81s in the periphery. Now, there's been a big tightening that we've seen sort of in the last few months, and we view this as an opportunity to reduce some of our risk. Having said that, we still see value in things like Alpha and some of the Greek AT1s. When we think about some of the AT1 spreads we see out there, we're still looking at spreads, around 450 to 550 basis points or higher. And, this compares to when we look at European crossover, which is at this point trading, closer to 290. So there's still sort of a significant, a short base there, and we could see more spread compression to go. As Alberto sort of talked about briefly earlier, structurally, one of the things that we like is mezzanine risk. What do we mean by that? Which is the fact that we expect dispersion to go up. We do expect idiosyncratic defaults. So what we don't want to do generally is be in the equity tranche of the global markets, but specifically in the indices. What we like instead is sort of the mezzanine or the second default tranche, or the 10-20, which today is still pricing in a default rate in Europe of closer to 20%, which is much higher than historical, which has typically been below 10%. This again has tightened pretty significantly, but when we think about the rest of the market, it still offers value at sort of over 500 basis points in spread. Finally, turning to a more idiosyncratic story, which is Ukraine, where we've been focusing on is the corporates more recently, where essentially we see the fact that earnings have been strong. EBITDA in some cases, like Metinvest and MHP, have recovered to almost pre-war levels, and they do have assets outside the country to sort of negotiate with bondholders, either about a full repayment or about sort of reprofiling. And sort of that's a very interesting trade for us, where they're still about, they're trading typically around in the 70s with a duration of about 2 years. The Ukrainian sovereigns also still very interesting in sort of the high 20s. Obviously, the catalyst is more geared around a restructuring, which would be dependent on more aid coming through. Our understanding is that if the U.S. House bill is passed of $60 billion or near there, it would allow the government, or it would enable the government to then approach bondholders to avoid extending the standstill and sort of pursue a more active restructuring. And then finally, on the short side, as Alberto sort of highlighted, fundamentally what we're short are SPV type cap structures. What we mean essentially is, things or business models that depend on a low rates environment and have needed a low rates environment to survive. One example of this, which Alberto mentioned earlier, is Intrum, which is something we've been short and have been talking about on these calls now for the past few months. Intrum today announced that they're looking at some kind of debt restructuring. It's unclear so far, how they will approach the market and what exactly they will propose. But what's clear is the fact that even to them is that their capital structure, as they have said, needs to be put on a more sustainable path. So this is a name that we've been short since last year into sort of the announcement today, and it highlights, when we think about our shorts, the kind of structures that we look for. I'm now going to pass on to Brendan, who will be talking a bit more about some of our special situations, which at this point give very uncorrelated alpha opportunities.
Yeah, thanks, Ali. So as Alberto mentioned at the outset, we've seen a notable uptick in dispersion within the credit markets, and we think that this has resulted in a lot of very compelling opportunities in some of the corporate credit space. So I'm just going to run through a couple of examples just to give a better illustration of the kind of things that we're talking about. So one name is a French facility management company called Italian. It's something we've followed for 6 or 7 years. We've met with the previous management teams, and it's gone through quite a long and complicated restructuring, which we've spent a lot of time understanding. And given our knowledge of the company, we've been able to take a kind of a longer term view on the free cash flow generation and ultimately on the valuation of the business. And for senior secured paper, we think there could be double-digit returns here. And from a risk-reward perspective, we really like these kind of trades. Something else which I think people will be a lot more familiar with is the US retailer Macy's. This is a name that more often than not we've traded on the short side through CDS. However, in recent months we've seen interest from a financial sponsor which put in an offer, which rejected. Now they put in another offer. And our understanding of the documentation, what a pro forma capital structure would look like should a transaction go through, has resulted in significant upside convexity in the bonds given where they're trading today. And then another name I'm just going to touch on is a company called Arda. This is one of the biggest glass and metal packaging companies in the world. And again, it's got, obviously it's got a huge capital structure. It's been extremely volatile. There's lots of different ways you can trade this through senior secured bonds, unsecured bonds, PICs. There's CDS. There's, an entity that's listed through a SPAC that also has debt outstanding. And there's a near-term catalyst with a potential refinancing of one of their senior secured bonds, probably happening within the next 3 to 6 weeks. So those are some of the kind of things that we're looking at. I mean, there's a lot of other situations that we can touch on another time, such as the automaker McLaren. Adi mentioned the UK pub company Stonegate, which again we think there's a near-term catalyst as it comes to address its capital structure, which has a very good asset backing, and also in the debt collector space, which both Adi and Alberto mentioned earlier. So I think to summarize, I would say that we're very excited about the opportunity set that has come up in recent quarters. And given where we are in the credit cycle, we think that the level of dispersion and the number of sort of alpha generating opportunities is only going to pick up.
Thanks, Brendan. These are some of the examples of the opportunities that we're looking at. But overall, this is a slide that shows you how the portfolio is positioned. And essentially, even though the credit market as a whole is relatively tight right now, our opportunities, the opportunity set that we're active in has pretty good convexity, meaning that these idiosyncratic opportunities in a market upswing, they can generate pretty good potential gains, while at the same time market-wide hedges, the hedges on the market as a whole, widening, they are relatively inexpensive right now. So we have a relatively nice smile in the portfolio. And to conclude, we have had a lot of debates across investors and economists about whether we are in a soft or hard landing. We think we're not in a landing. We think that these debates come from using a framework that looks at past cycles, past recessions. There's two very different things right now. One is that every part of the financial system has extended maturities, so there's less sensitivity to front-end rates. And the second is fiscal policy has become pro-cyclical from the first Trump administration to the Biden administration. Spending goes up even when unemployment is really low. So we are actually in an extended cycle, at least until elections, and then we'll see what the next administration does. If the next administration is a Trump administration, then there's even a higher chance of reflation and the potential for the pivot that the Fed implemented last year to look a bit like a policy error. The window for cuts is right now, and into year end. There's a bit of softening in the economy, but obviously this softening might disappear, it might turn into a reacceleration if fiscal policy continues to be strong, especially if a Trump administration comes in. And so already we are seeing, we're seeing in the market the effects of this pivot into higher rates and higher into reflation, higher activity in the housing market, higher activity in the lending market. And that's why there's a lot of capital on the sidelines. Now, what it means for us is that on the market as a whole, we're not buyers. We're in a tight spot. Rates are still pricing a good amount of cuts, probably too many, and spreads are close to record lows. But as we continue to stay high for longer, these capital structures that were not sustainable, that we flagged for a long time, like Intrum, we flagged for over a year, are starting to restructure. And as default rates start picking up, we see more opportunities for both longs and obviously shorts on the weak capital structures, and longs on the names that maybe are a little ugly, but they will recover. So pretty exciting environment from an alpha perspective. You have to be cautious if you're in market-wide strategies on credit, in our view at this point in the cycle. But the good news is our strategy tends to be negatively correlated to the long bias of traditional credit strategies. And with that, I'm going to turn it to Hope for any Q&A. Thank you.
Okay, great. So sorry everyone for some of the technical issues on the slides, but we will send those around afterwards. We had one question that came through. How do you manage to include the fact that flows in money market funds could come back to riskier assets? Interesting question on flows. If you guys could take that one, please.
Yeah, I mean, I would say, so the question is, how do we take into account of liquidity and money market fund flows? So we're very aware of liquidity. In our framework, in our models, we look not just at central bank liquidity, but also flows of funds. And there's two reasons why you don't want to be short in the market right now yet, or at least not yet, or not in a strong directional way. So you want to be more cautious, but not strongly short. One is that a lot of market participants went short the market in October, and they took a long time to cover. Not all these shorts are covered. So there's underinvestment. So the technicals are still positive for a tightening market in spreads. And the other reason is, as we showed before, fundamentals are not deteriorating. So companies are not taking advantage of low spreads to lever up. Valuations, however, as we think about our framework with valuations, fundamentals, and technicals, valuations are tight. So that's where you want to go in the right names, in the idiosyncratic opportunities that have a catalyst and that are off the benchmark and where investors haven't gone so far. There's a number of reasons why investors haven't gone into some of the European names or into Ukraine and so on. Usually it's binary opportunities, but opportunities that have a lot of convexity. So we look for convexity, we look for a catalyst, and we look also to be tactical in these names. We tend to be quick. We don't have things that are illiquid, and we trade them both on the long side and the short side. And in our investor presentation that you can have, if you contact Hope, you can find more details about how we are tactical about entry points and exit points on the names that we trade.
Okay, thank you for that. Yeah, we have one more. What's our favorite position? And let's add on the long and short side, if you guys can go through that one.
I mean, that's
pick favorites here.
Favorites. I don't know. We can answer each of them. each of us. I think one of my favorites has been
Lightning
the mezzanine
Okay.
tranche, the 1020, which is essentially the second last tranche to the index, to the high yield index. We bought it in the mid to low 40s last year. Now it's in the low 60s, and it still has 15-20% of upside this year.
Which is doing, yeah, I mean, I would agree on the 1020. I would also talk about, in this market, we're essentially looking for convex opportunities, and there are two additional places you can get that. One, we're looking at convertibles. You can buy convertibles today, a number of sort of cyclical companies like Lufthansa, et cetera, which, you can trade them around par to 107. That makes a lot of sense to us. And sort of another one, sized correctly, is the Ukraine opportunity, where we essentially see, a 1/3 type payoff.
Yeah, so just in terms of prices, Ukraine is something that was trading below 20 cents where we bought it, and now it's in the mid to high 20s.
Yeah.
And ultimately, we are potentially going to a 40-50 cents market if the restructuring happens, especially it's likely to happen before elections. So there's a near-term catalyst there.
Yeah, and I would just kind of add to that as well, the Ukraine corporates within that space. And I think sector-wise, I think the energy space is something we've liked for a while, and there's still pretty decent spread pickup for very good quality credits versus the rest of the market.
I mean, on the shorts, I would say my favorite short from a top-down point of view in the market as a whole is triple Bs and cyclicals in IG. They've been extremely bid. Everyone has been long high-quality credit. No one ever gets fired by being long high-quality credit, but they're very tight, so they don't pay you. And a lot of triple B cyclicals, from the home builders like Toll Brothers to automakers like Renault, cyclical industrials like ThyssenKrupp, they're all trading around 100 basis points. And they don't pay for either a widening in rates. So if the economy is too hot, these names will potentially widen with higher yields. And similarly, they don't pay if the economy is too cold, if there are downgrades and defaults later in the year or next year. So if we are wrong about the no lending and there is a slowdown or recession, then the triple Bs are a pretty good hedge given where they trade right now and potential downgrades to high yield, although that's not our base case scenario.
Great. One more question that's come through. Do you have a view on emerging market corporates? And if it's the case, you identify an overweight sector, country, or rating bucket. If you guys could just comment on how we look at overweights and emerging market corporates, please.
Yeah, thank you. I mean, so emerging markets are a very large bucket with a lot of different things. So I would say in EM, the good names, the performing, are extremely tight. So we're, again, talking about a very narrow premium. Similarly for US and European investment grade. There are some interesting opportunities, but I would say it's an asset class where we are cautious because we have seen many of the names, sovereign and corporates, with risk being appreciating a lot, from including the distressed names. So I would say two areas that we like a lot are obviously Ukraine. The corporates in Ukraine are very interesting. Some of the energy producers or the metal producers generate a lot of hard currency revenues, and they're actually able to refinance these bonds early and independently of the sovereign deal. So there are some areas where we think there's value, and value in the sense of double-digit appreciation. There's other sectors which are interesting. For example, in the energy sector, I mean, we've been involved in Pemex for a while, and we're pretty positive there still into elections.
Yeah, I mean, I think, Tolbert, I agree with what Brett was saying. I don't have much to add to that. I think fundamentally, when we think about a performing sovereign, we prefer the sovereign over the corporate. Typically, the only exception sort of is Pemex. And when we're looking at a distressed sovereign, we typically prefer the corporate over the sovereign. As sort of a general sort of broad aspect. In terms of sectors within within any given sovereign, we're quite neutral. We don't have a specific view in any given sector.
Right. Okay. I actually think that's time for us, so we'll leave it there. Any questions anyone has, please feel free to get in touch with any of us directly, and we'll be happy to follow up. I mentioned we'll be sending replay details around with the slides, so you'll have clean versions of those. And otherwise, thank you all very, very much for joining us, and look forward to engaging with you further.
Thank you for your time.
Thank you.